Well, why don't we start with a little bit about you and your career? This podcast is something that we kind of capture all different professionals on. We've had a CIO recently, was our last episode with Dan Kelly, and Tina and I are on Talk Time with Tom and Tina, which is a regular segment. Why don't you tell us a little bit about yourself, mate? And obviously you're Craig McKenzie, the real estate agent who we've done a lot of work with, but maybe like a bit of a boilerplate for listeners.
I started in real estate a very long time ago, back in 89, effectively, and I was the kid. And listing was very difficult for a 19-year-old back then. You had to have grey hair, and now I wish I didn't have it. But started in 89, spent 14 years back then in the industry. I had my own office for a period and was very young. I got a little bit tired, and I spent my entire 20s, that young period where you're out and you're having a good time, and I'd turn up on a Saturday, and I worked Sundays as well back then. I'd turn up or have to go home early. Yeah, from a party or whatever the case may be. I got a bit tired of that, and I was looking for a different life because weekends were terrible. So I went into advertising. I was in radio for a while, and then basically evolved into an ad agency effectively. And had my own ad agency for quite a long time, about 18 years. But a fairly unhappy period for me in advertising. I didn't love the business. I always loved real estate, and I wished to come back and hoped to come back. But when you're in a business and you're making money and you're paying for mortgages and all the other bits along the way, the money won effectively. Look, I was given an opportunity to come back into the business during COVID effectively. My ad business changed dramatically in that period, and all of my clients rang me that dark day in March. It was about the 23rd of March.
I remember it well.
There's no scars there. Back in March, they all rang me and said, Craig, take everything off air, shut everything down. Don't do anything from here on in.
I remember the employer that I was working for at the time, they were turning the computer monitors off to save money on the electricity bill. Like, that's when you have total fear of the unknown. We're trying to save cents in a month on saving electricity on the computer monitors. Also, I remember going home at the time and I was watching the news and just the tanks rolling into Ukraine as well. And it was all happening at the time. Crazy time, isn't it? Can you believe that was 6 years ago?
I talk about that often with people, how time flies so quickly. I mean, everyone thinks COVID was yesterday. It really wasn't. It was a lifetime for some people.
I mean, it's almost like the closest thing to PTSD that I've ever had. Imagine being in a room all day and not going outside, maybe getting some sun in the backyard, like really scarring, I think. And obviously the guys down in Victoria suffered a lot more than we did here in New South Wales.
We don't really care about it.
Mate, I think the only time that I'll talk to some Victorians is when we're up against them in a sporting coat or something, you know?
Yeah. Even then, it's probably not worth talking
Timely, actually, talking about kind of how fast time goes, because right now it seems to be flip-flop when it comes to the real estate market. And I appreciate that real estate market's quite a anecdotal thing to say, because different markets can be micro markets, state markets, a suburb. You obviously operate in the inner west. Why don't you tell us a little bit about what you're seeing in general at the moment? Markets going up, markets going down, rising, falling?
I've been back in real estate now 5 years, and the market has been dramatically different over that entire 5-year period.
Yes.
The COVID period, 21, it was crazy. There were people everywhere buying anything. All the rules went out the window as good property. They just buy whatever's available.
Right.
Then we went through the interest rate rise period, and then the market sort of shrunk back and then increased again. We've hit this period very recently. It was starting to slow down early in the year anyway, with the obvious Iran war situation over there.
Multiple interest rate rises.
Multiple interest rate rises, obviously. All of the components were all coming together for it to start to slow down anyway. And then we had the budget. And the budget may be, in years to come, one of those things that had such an effect on the market and such a dramatic effect on the market. And more so, I think, to a failing confidence market anyway, that it was pretty much the death knell at the time. And I say at the time because things have sort of evolved a little bit since then.
Okay.
You'll hear all the doom and gloom, and it's not for me to go and paint a different picture from everyone's opinion. But what I'm seeing, and only very recently seeing, is a very segmented market.
Right.
There are particular price ranges that are very active.
Okay.
I can only use my particular area and my experience in the area and the type of buyers I'm dealing with. As an example, because I'm not all across Sydney, I'm not dealing with, you'll hear a lot of different commentators. Tom Panos is very upset at the moment about a number of different things that have happened in the markets that he's seeing. Whereas the market I'm seeing, which is the Drummoyne, Abbotsford 5 dock in that inner west space, the upper end of the market has softened considerably and it is quite difficult. But we're also talking about multiple millions of dollars too in those homes, and they're mostly houses. Anything from sort of $3.5 to $4 million plus has softened.
Okay.
And we've got a couple of little segments in the market, for instance, anything between sort of 1.8 and 2.5.
Yes.
Seems to be a real sweet spot in our area because you've got downsizers coming from houses into that market as well. And you've got the younger people coming out of, they own property already, an apartment, maybe a 2-bedroom apartment, and wanting something bigger, or they're wanting a semi, or they're wanting a townhouse or something larger than their 2-bedroom apartment. They're meeting in the middle, I suppose, and that seems to be what's happening as far as the sweetest spot in our market. And we're getting quite crazy numbers through open homes.
Give me some examples.
We've had a couple of properties recently, and only in the last couple of weeks, and I'll suggest that prior to that it was tumbleweed in some cases, and we're getting very small numbers through houses.
Yes.
One particular case, I've got a semi in Drummoyne.
Okay.
Beautifully located, great semi, 3 bedrooms, and I was getting 2s and 3s through my open homes, and a handful of people interested but needing to do a number of different things. They need to sell their own home before they can actually transact. A number of different factors for them not being able to transact, or something else needing to happen before they do that.
There's no urgency, basically.
Well, they couldn't act because they were on the other end of the market, basically trying to sell a property themselves, and they needed that to domino them into their next purchase. Well, their numbers on their own are low, but very low numbers, to the point where I cancelled the auction and put it on market.
Right.
I brought the price guide down. I had 17 people through that property and had an offer on Saturday, and 2 other people currently in negotiation right now on that property.
Wow.
Other than the initial offer, there's 3 parties all negotiating on the property at the same time.
Kind of goes to show you, doesn't it? Like the initial hysteria of fear of the unknown doesn't last forever, right? And the numbers speak for themselves, right? It's like, it's a statement of fact that you've changed the campaign and all of a sudden you almost had a restart and all of a sudden there's 17 buyers. I mean, that's just huge. I remember that kind of sentiment as well during COVID. It was quite comparable. If I could kind of compare now to COVID, it's the most closest thing I can think of in terms of buyer sentiment and market confidence. And you think about the end of 2020 there was kind of November or October, that kind of area was when the market started to return of sentiment. There was a little green shoots coming through the soil of sentiment. And I wonder if that's a marker, the first green shoot of sentiment returning. It's like a stock, right? Stock, they get some bad news and people react and everyone sells and the stock plummets. And people think, actually, the world hasn't crashed, not that bad. I wonder if that's an example of that.
Look, I said this to someone only this week because we've had a number of properties. They're in similar price ranges, that sweet spot that I was talking about. They haven't had price changes necessarily, and they're certainly not underguided by any stretch of the imagination. But it sits in a part of the market that is relatively active. We weren't really getting those numbers through that price range at a great level, but I think good property is always well contested.
Yeah.
And that adage can be used in any market and any economy. But the other thing that we've noticed is that with Australians, they go through the shock period.
Right.
And they say, all right, well, no, let's just not do anything.
Right.
When something dramatic happens, and that was effectively the budget. Everyone sort of, what does that mean for me? I don't understand. I'm an investor or I'm a first home buyer. We don't know what it means yet. So they all stop. And then Australians are funny like that. They say, all right, well, that's what it is. Let's get on with it. We've got to go and do something. We really want to move anyway. And it's almost an acceptance of, well, that's what the market is. Let's go and get on with life because we're not going to sit here forever. And that may have been the case during COVID. I mean, COVID probably had a few other factors. The interest rates were quite low and it was a bit of a perfect storm, I suppose, to create that boom. But at the moment, there's a level of not confidence, but acceptance, I think is probably the better way to put it. Of that's what it is. We want to move. Let's go.
Well, certainly with the clients that we have, that's been the storyline for the last 3-4 years with interest rates. And interest rates have risen and fallen multiple times over the last few years. And certainly if you were borrowing on those 2% interest rates during COVID, which many people did, you've really been through the ringer. And so I wonder now if those people that initially were buying the apartment that you talk about. And as you say, now is the time for upsize, as it seems to be quite a favourable market in that particular segment. I wonder if, as a result, there's been so much change and the media has given it so much attention that it's almost a bit of an overload. And it's like, you know what? I still can pay my loan. I'm not radically affected by this. I wonder if those buyers are now just blocking out noise and taking advantage of the fact that they've kind of been in the trenches and now they've kind of been through the war zone of interest rate movements, which are at the highest they've been in over 10 years. And so they've kind of got that confidence now. When you're going through military training or something, you reach a new mental capacity you didn't realize you had, right? So I wonder if buyers are so battered by that, especially first home buyers too. I certainly see that with our first home buyer clients as well. Does your market segment have many first home buyers?
Yeah, and worth mentioning in the sense that that's another part of the marketplace that is busy.
Yeah.
Anything in that, I'll say sort of 900,000 to 1.2, 1.3, that's been very active too, and active to the point where it hasn't seen the drop that it's actually, some might say, no two properties are the same, so you can't, unless one property sells exactly the same, or they're side by side and they're identical. But that market has actually grown, and they're paying more now for that particular part of the market.
Right.
So they're probably winning. Those that owned those 2-bedroom apartments are in a good position to say, well, we've not lost anything. The gap has actually shortened. Between the leap to the next stage for us.
Right.
You know, we've got 2 kids. We can't live in this 2-bedroom apartment anymore. And there's quite a few of those conversations with young families happening at the moment. And they own a property. And the first home buyers, there was a suggestion that it was going to be a big advantage as first home buyers that the market's dropped. And I've seen plenty of things around saying from different members of society saying, you know, a first home buyer, no investors were there. The first home buyer paid, you know, this small sum. And that's not what I'm seeing.
Right.
In that part of the market, we're seeing a real resilience on price. And even a level of growth in that part of the market. So it's hard for us to sort of suggest that these changes have advantaged the first home buyer. But look, I'm only talking about my part of the market, and it's a very small part of the Sydney market. So I can only sort of comment on that.
What do you think makes the difference between a suburb that performs well and a suburb that performs poorly in the same market like this? So you obviously cover a few different suburbs, as you mentioned before. Yeah. Would you say that some perform better than others? And if so, why do you think that is?
Reputation.
Okay.
Some suburbs have a different feel to them. And there are a few other things in the inner west in particular that have come about to probably create a bit of growth.
Okay.
And desirability with cafes, lifestyle. And if you start just with your first home buyer, they're not looking to sort of be a long way away from where the action is. They're looking to buy an apartment somewhere where they can go out and have breakfast, they can go and have fairly easy access to transport. Mind you, a lot of them utilise Uber before they use the public transport.
E-bikes anyway. Now too.
Yes, across Sydney, that's
everywhere
the case. Look, it's the desirability of the suburb, and in the inner west, we get that. And I've always been a big advocate for use your budget in a better suburb that has better capital growth than try and buy the biggest place in any suburb.
Right.
And it's sort of a mentality that you need to change. Don't buy the biggest place a long way away from really where you want the lifestyle, because that's the biggest place. That's the biggest property I can buy for the amount of money that I can afford.
Yeah, I've seen this before.
Try and do a different match. And I even suggested to someone, there was a middle-aged couple came in, they were looking for their son.
Okay.
And they're talking about him buying a property, and they were suggesting he was looking in a number of different suburbs. And I just suggested to them that he look into ChatGPT, and I'm sure this young guy can access that quite quickly.
Yeah.
And go and put into ChatGPT Capital growth over the last 40 years, this suburb versus that suburb, same amount of money spent 40 years ago. What is the end result? Who wins? And they said, yeah, we not even thought of that as an idea. And that really gives credence to, and when you see the numbers, gives credence to go and buy in a better suburb. And that can be transport, that can be lifestyle, that can be, look, there's suburbs like Marrickville now has had a real resurgence in price and desirability. And there are plenty of suburbs around Sydney that are probably undervalued at the moment because they're delivering what neighbouring suburbs deliver, but aren't that popular, but they're very close by. You look at the difference between Ashfield and Haberfield. You've got the Parramatta Road between the two of them, and the prices are very different, one side to the other.
You know what? I totally agree with that. During COVID, what I saw was there was this geographical expansion outside of the key suburb. Like if you kind of gave everyone a kind of a dartboard, you say, okay, put 3 darts on the ideal suburbs you want to go, and they'll put them in Ashfield or they'll put them in Glebe or whatever. And then they say, okay, well, what can I get for my money? And they can't afford, or the mortgage is too high as to, you know, what they want to buy. And so then they go, what's the next best suburb, right? So they go to the next suburb over. And you kind of get this expansion out and out and out and out and out. And then it eventually gets really far. And what happens in my experience is when you see this contraction back towards that geographical center is when you have the market confidence down, interest rates are high, and you have buyer sentiment is, you know, tumbleweeds, to use your word. And so as a result, you end up, that's where you see these massive price adjustments. In my experience, seeing what other clients are buying at the moment. And it comes back really quickly because ultimately those suburbs that are on the outer, if you can then buy the same property, but for the same price now in the suburb that was one closer to your geographical center, then you're going to buy it there, right? And so I certainly are seeing a bit of that, even now, actually, as well. So it'd be really interesting to see, you know, the Great Australian Dream. I think it's still alive, but it's just going to be in an area and in a situation where I think we have a different standard of living now. You know, it used to be that you would live in a house and you would have your 200, 300 squares. But now it seems to be that we're adapting to more like New York, where it's apartment living. And certainly that's the direction that the government seems to be taking, 2 or 3 bedroom apartments. Have you seen any changes or any comments from buyers or any changing behaviours when it comes to whether the first home buyers are still looking for a townhouse or a house, or is it they're kind of consoled to the fact that it's going to be an apartment now?
Look, there's a few factors there, and this is going to vary suburb to suburb.
Totally.
But and I've mentioned this before in conversation, the bank of mum and dad is quite prevalent.
Yes.
And we're having conversations with younger couples, and mum and dad are very heavily involved in these purchases.
Yes, that's right.
And they're very heavily involved in the initial deposit, and mum and dad are wanting to drag them into the better suburb because they want proximity to their grandchildren. They want them to grow in a better area, and they're helping them along the way. Look, as far as that part of the market, I think the first home buyer market is busy, and their level of acceptance that I've got to buy a 2-bedroom apartment, certainly in our area, hasn't changed.
Okay.
If they're growing and they're getting mum and dad to help them, or they've got a better job, or they've been promoted, or whatever the case may be, and they've got more capacity now, they're sort of looking at the townhouses and up to $2 million ceiling, which is crazy. It's a lot of money.
Mate, it's crazy. The gifts. So I've seen them up to 3 million. I think that the largest gift that I've had is as part of a purchase for the application, and it's bigger than the loan itself. But it's very common. I'll see gifts ranging from 50,000, 100,000. I've had parents borrow to make a gift as part of the purchase for the son or the daughter. Take on debt just to, you know, effectively they're sharing the debt load for the son or the daughter. So it's not uncommon. Another issue I see recently, there's actually a good article in the AFR recently about this. I'll put maybe a link in the description. It talks about where the bank of mum and dad goes wrong. And they cited 5 cases where usually it's in relation to a breakdown of a relationship or a property that's been sold or someone passes away. And for family court reasons and family protection reasons, often these are made by a loan, quote unquote. And you've got to be careful with those when it comes to borrowing with the bank, because if the bank deems that to be a loan for the purposes of serviceability, then your borrowing capacity can be dollar for dollar affected by that loan. So it has to be structured in such a way, after getting legal advice and accounting advice, whereby it doesn't impact on serviceability and there's no regular repayments that are required to be made, but also protects the family from a relationship breakdown or a future relationship breakdown. I've also seen protections in place for those as well. You know, this serious sums of money being given here, right? And so certainly it's prevalent, but it can also go really wrong as well if not done the right way. The other question I wanted to ask you, in particularly pertinent to your area, is investor activity So we had some recent data that came out from Loan Market, which is the aggregator that mortgage brokers use. It's one that I think it's the biggest one that mortgage brokers use in the country. And investor lodgements for loans are down 35% now, right now, at the moment. It's a huge reduction. So 1/3, right? Is there much investor activity in your market segment? And no, there's not. And why do you think that is in the inner west there? Is there a particular reason?
Well, it's probably comes down to yield as well.
Yes. Yeah, yields can be very depressed in Sydney, can't they? Especially in Manly here where we are now. You know, I see properties and they yield 2%. It's a terrible return. Right? You wouldn't want to live in a, you know, it's more of an owner-occupied style, I guess. But I guess that makes good for investment returns. I don't know. So the reason I talk about that is because that obviously talks a lot to the market sentiment, right? So if you have investor activity that's really low, and obviously that depresses further the market sentiment and the market confidence, I wonder if it's a fundamental change. And the government certainly talks about that in the announcements that they make when it comes to these changes for negative gearing and the tax policy. And so I wonder if it's a fundamental change for how property has capital appreciation in especially the major cities because the yields are so poor. So do you have any particular thoughts on that?
Yes, the investors have been sort of disappeared from the market a little bit for the last couple of years anyway. You don't see as many investors. However, when the budget came down, investors were calling us saying, we're no longer interested in that.
Is that
property.
right? Yeah.
And it could be a number of factors, and time will tell. Investors need a new strategy. But if they're an investor, it's not really about property. They're not buying anything emotional.
That's right.
They're not connected in that way. They don't need it for any other purpose. It's about making money. So I've spoken to a few recently that are looking, and especially with the SMSF, how they are going to structure and what they're going to do. And I think at the minute, it's probably a level of confusion as to, or uncertainty as to how they're either going to structure it or where they put their money to ensure that they're getting the return, because it's really only ultimately about return.
Yeah.
It's not about real estate or whatever it is.
Yeah, it's a great point. I think for the first time, and maybe they were before, but I mean, in Australia, for generations, it's been making you wealth through property, right? Literally generations on generations. And I think for the first time now, we potentially are seeing a changing of the guard where there's been such a dramatic change to policy and dramatic change to the market conditions. And also the emergence of the ETF, I think should be mentioned as well. I mean, that was traditionally used to help accelerate a deposit for a property and then get into the investment property as the first property get to the market and you transition that way. But I wonder now if it's a bit of a change of the guard when it comes to, okay, well, maybe I just continue on my ETF path. You know, you mentioned the SMSF borrowing, which also has been banned as well, right? So not only was there significant changes in the SMSF space by way of tax, but also you now can't get access to a loan in an SMSF to borrow for an investment property. And there's been significant attention to that. And the SMSF lobby is, going very hard at the moment. And certainly that space has made up a lot of the off-the-plan development space. A lot of SMSFs, the borrowing capacity is restricted. You've only got rent, super contributions, and any dividends or any other asset form of income in the super fund, which isn't generally very much for most people. And so as a result, the type of property you can buy in SMSF is not $3 million house. You're looking at a $600,000, $700,000, maybe $1 million apartment, which often was off the plan. Certainly in those kind of segments, I think will be hit hard. And I think that we'll see a changing of the guard when it comes to investment activity. And I just wonder how that's going to impact overall. I mean, you'd think that there'll still be some investors in the market, but the type of property that they'll be looking for will be dramatically changed. It'll be maybe one now that's looking for yield. Or it'll be a brand new property that is still able to attract negative gearing benefits as well. One other category, and I see recently, this kind of category has evolved. You used to hear about the mum and dad developers who would buy, a knockdown rebuild and they'd put a duplex on the site or rebuild the property and have a granny flat out the back. Because that contributes now to supply, there may be the ability to negatively gear those types of developments. And so we may also see a change of the guard when it comes to more mum and dad developers, quote unquote. Certainly I'd say my first couple of calls in the last couple of months about this as people understand the tax rules. And so I would expect there'll be a dramatic increase of duplexes as well to accommodate for not only changing living standards, but also that's obviously what the investor's being drawn towards for the tax planning benefits as well.
Well, it's just to re-strategize what the plan is now. And I think the current pause is we don't have our plan yet. We don't have the strategy as to how we're going to move forward. So that may well be something that is sort of prevalent in months to come, but when the dust settles effectively.
What are agents seeing at the moment that the headlines aren't reporting?
Yeah, look. Sometimes people and the media tend to deliver this is what's happening in the market. Now, as I've explained today, I can only speak of my part of the market. Now, if you spoke to an agent in a different suburb that might be 10 kilometres away, and Tom Panos is a perfect example of an auctioneer that is operating in suburbs of Sydney, and it's quite dire.
Yeah.
So everyone's story is going to be very different.
Yeah.
But there is this general view from media that that's the real estate market. And, well, no, it's not. There are, as I've explained today, many parts of every single real estate market. And we can talk about mine. There's multiple parts of my real estate market. The first home buyers are busy and are paying as much, if not a bit more than they would have a year ago. And then you've got other parts of the market that are slower. So to have a general view is that's the real estate market in Sydney is totally wrong.
Totally wrong. Yeah, I totally agree with that.
And it's misinformation because it's good rhetoric for them to sort of get headlines and ears and eyes on things, but it's not the real story.
In your segment in the Inner West, how are vendor expectations at the moment? Are they elevated? Are they needing to be adjusted? Are vendors meeting the market? Any particular comments there?
We're still selling quite a few properties.
Yes.
That really hasn't changed a great deal.
Yes.
Yes, the prices have changed in certain parts of the marketplace. Okay. We're getting really good prices in other parts of the marketplace. So the market decides that. Okay. Us as agents don't decide how much something sells for.
Yes.
The actual market decides that. We facilitate all of the parts to make it happen, but someone's not going to pay more than they are prepared to pay for a property. Yeah, so it's...
Yeah, I think certainly from my perspective, we have clients countrywide, and there are certain regional parts of the country haven't particularly changed in terms of competition and vendor expectations. Those types of markets seem to be... It's kind of very neighbourly, if you like, almost. I think really the competition and the vendor expectations and market sentiment, you can talk to the capital cities really well. And certainly you've got your WA, your Perth, you've got Adelaide, and you've got Brisbane. And they were really strong investor hotspots in the last 6, 12, 24 months even. And there was a lot of buyers agents that were seeking kind of the next best thing. And those markets are suffering at the moment, big time. And so as a result, we've got clients that are vendors and having their expectations massively adjusted because there's been an evaporation of support for prices in those areas. Really interesting to kind of see the different dynamics. And I think it talks to what you're saying about the media as well. It's a totally different market. And to report the average data across Australia, I mean, how can you relate that to the cities? Can't, right?
I don't understand how they can stand behind that as a statement often, because they want to make a general statement and they either want to make it as sensational as possible or as dramatic as possible to try and get some reaction. But ultimately, I look at the entire Australian market as well.
Yes.
And you mentioned the Brisbane investor market and the Adelaide investor market, and even their greater market than that, over and above the investor market. I think that was artificially manipulated, not by themselves, but by a migration from the Victorian market. And the Victorian government did some things down there that created, well, if you like, I don't like it anymore, so I'm going to leave. And those investors left that market and probably won't return now. I mean, they may, depending... Who would have thought they'd have left?
Depressed for ages down in Victoria. I haven't seen people moving to Victoria because the prices are too good, particularly owner-occupiers. And I guess some investors who are quote-unquote speculating on return. Maybe there's a change of government, what have you. And I think what has to do a lot of that is the lending standards as well, right? Like obviously, not only if you take, you look at the actual policy on itself, negative gearing removed. Okay, well, maybe investors are now taking a back seat because they want to see what kind of pans out if there's a change of government, what have you. But the real consequences of that is that there's been a 20 or 30 or 40% reduction to the borrowing capacity of investors who want to buy a new investment property that's an existing dwelling and doesn't qualify for negative gearing under the new rules. That's kind of the skeleton in the closet, so to speak, that's really affecting these numbers. But it's not just that. You look at in the Inner West, right? Real brownfield kind of, there's no real land releases. Maybe there's some apartments going up that were brand new and you could obviously negatively gear those potentially. But as a result, what little activity was there, as you say, would totally evaporate now. There's just the borrowing capacity is just not possible. And I think we'll see as a result, there'll be people using multiple banks to get extra borrowing capacity. There'll be additional things that you can do to increase that further, but it is really hard to recover that lost borrowing capacity. It's so much to a point where it's basically you can't get back to where you were. That's how big the reduction was. And so I think that this change of lending standards and looking into the future, I think that If we do have another interest rate rise next month, which we'll see what happens, I think there may be, but the inflation numbers are way outside the guidelines. The only way that the RBA wouldn't change the interest rate is if there was political pressure, quote unquote. They would never admit that, of course. And then perhaps then as interest rates fall, the assessment standards are made more liberal, because at the moment, assessment guidelines are 3% above the actual, or in some cases it's 2 or 1, depending on the lender. But certainly with the major banks, it's 3%. So if you have a 6% interest rate, you're being assessed at 9% right now. And that is an interest component on a repayment. It just makes the repayment look like it's from Mars. And so there's certainly some lending standards that have contributed towards this sentiment crisis. I had buyers who had pre-approvals, and as soon as those changes came through from the budget, I was calling them, effectively their pre-approval was void. Had some of them that had been working for months and months to get into the position, refinancing other loans and incurring costs to get into a position to buy an investment property, and had the rug pulled on them. So I know that that's the target of the policy changes, but I think the swiftness of the changes has really hit people hard, especially now you put SMSF on top of that as well. Same thing was happening there. So really interesting to see the lending changes. I think the last thing we'll do today, we'll go through a couple of quick fire questions that I had for you from earlier. The first is green flag, red flag. Buying before finance approved. Green flag or red flag?
Red flag.
Waiting for rates to fall.
Red flag.
Yeah, I can't imagine. Well, look, some people do that though. Certainly a red flag. Buying the worst house on the best street.
Green flag.
I agree with that. Parents helping with the deposit.
Green flag.
Green flag, yeah. As long as it's structured the right way, make sure you get legal advice for the reasons we talked about before. Stretching your budget for the perfect home. Personal opinion?
Personal opinion. Depends on what you mean by stretching your budget, I suppose.
Well, I guess stretching your budget to the point where you can get materially better property for slightly more as a purchase price.
Okay, green flag.
I think green flag too. Yeah, that's my understanding.
That's why I wanted you to qualify it, because there are variations on the theme. Red flag.
How about going all in emotionally at auction?
Listen, you're asking a real estate agent. What are you talking about?
Green flag. I mean, property is an emotional thing. Certainly, if you want a property, I don't see any issue with that personally.
I would genuinely say red flag, because you don't want to be doing that, because you will put yourself in a difficult situation.
Yes. And you need to have buffers and contingencies.
Absolutely.
Yeah. Buying an apartment today.
Green flag.
I think green flag, as long as it's not from a dodgy developer, where you have massive strata fees and things like that you have to do later.
Well, due diligence is really important regardless of the property they're purchasing.
Totally. I can't believe people, I've heard stories, people just go to the inspection, no solicitor review of the contract, no changes. Like, yeah, that's total red flag. Man, that's a total red flag. I mean, never do that. You agree with that? Yeah.
Completely.
Yeah. Selling before buying. I guess it depends on market conditions, right?
Selling before buying, I think in the current market conditions is essential and definitely a green flag.
I totally agree with that. And I think that some of the vendors' understanding and also like what the property was worth just like last month could be massively different to what it actually ends up selling for when you get it going.
Unnecessary grief.
Yes, I agree with that. Renovating before selling?
Green flag.
Yeah, I think so. Go ahead.
Yeah, presentation is important, and it does, and proven time and time again, it actually gets you a better result.
The other game we have here is Craig's Crystal Ball, trademark. Property prices up or down from here?
I'm going to qualify that question and say in some areas up and in some areas down, and in some parts of the market up and in some parts of the market down.
I guess we'll talk for the rest of the year with these points. I think perhaps is the right kind of time frame to talk, because I appreciate it changes all the time. Auctions, stronger or weaker?
They'll be weaker.
Yeah. Interest rates, higher or lower?
I think they'll go up.
Yeah, I think so too. Sydney units, up or down?
I think up.
Yeah, I think so. Potentially. It depends on the area. If you have an oversupply, maybe not. Look at Epping and Homebush, right?
Again, qualified down to supply and demand in individual suburbs. And that's something else that everyone needs to consider is supply and demand in the area.
Biggest surprise the market will deliver by the end of the year? Any particular thoughts? If I was to think about a surprise that the market would deliver, I think we'll see a massive bull rush in the end of November. And the reason I say that is I think what will happen is there will be a segment of the market will catch the falling knife, and that segment will be the next home buyers. So the ones you were talking about before, going from the apartment to the townhome or whatever. And that will spur a recovery of sentiment. And as soon as sentiment recovers, you know better than I do, mate, that's when it's on, right? Then it's like, okay, it's back to how can we get into the property faster? I need my approval yesterday.
And then it goes back to supply and demand, because there'll be limited property come on the market when there's difficulty and prices are dropping, less people want to sell, and they only sell when they have to sell, which is a contraction in the market. And if there's an increase at any point in approvals and people coming into the market, that balance changes, and that change in balance will change price, because it's the only factor that can change when those two pressures come to bear.
And you couple that with inflation coming down and you get a rate cut. I think a lot of people see interest rates as almost like a marker as well. Not all the time. I think if you see, like, that's why it's such an interesting dynamic right now. The closest I can compare it to is COVID. I mean, look at the auctions. Auctions 40% clearance rate. Last time in COVID, they couldn't go outside, and we had similar auction rates. It's like, kind of like a stock market. Like, it goes below, people are panicking, catching the falling knife, and then it goes way below where it should, and then everyone's like, actually, maybe that should be a little bit higher. And then that's when the recovery comes and it kind of continues on its trajectory. Well, that's good, mate. Well, thank you for coming in. Appreciate your insights.
My pleasure. Thank you.
And should certainly do that again. And if the viewers have any questions, we'll pop your details into the summary part of the video. Sure. And I'm sure they'll reach out if they have any.
They're welcome.
Thank you.
Thank you. Talk soon.